Hey everybody, welcome back to another pipeline trading lesson. Today's lesson will be an advanced tutorial about how smart money trades, which is a trading system that follows the institutional forces with the ability to move the market. First, we will explain the concepts of demand and supply market structure, and liquidity from the perspective of how smart money trades. Then we will cover a complete trading plan, including 3 of the best strategies known as sniper entries. If learning advanced trading strategies, entry reasons, and how to stay disciplined with a trading plan interests you, then subscribe to my channel and enjoy more advanced content to execute the strategies effectively. You need to understand the concepts first because they are the foundation of this trading system. Success depends on applying them correctly to the chart. Let's start with supply and demand. Supply or demand is a zone where price rapidly pushes away, creating inefficiency in either a break of structure or a change of character. There are 3 factors to consider when identifying supply and demand areas for trading. Did it create inefficiency? Did it break structure or change character? Did it create liquidity before the zone? Inefficiency occurs when there are gaps between candles. When this happens, price is more likely to come back and fill the gap. A break of structure is formed during trend continuation. Every time price breaks a structure level in the same trend direction, it signals continuation. On the contrary, when price breaks a structure level in the opposite direction, we call this a change of character. This signals a possible trend reversal. Supply and demand zones are most effective when they break through 2 or more previous zones. Change of character forms after a higher time frame mitigation. When price impulsively breaks through zones with a few large candles, liquidity is essential. If smart money wants to buy a large number of contracts, they need sellers in the market. The conditions that allow these orders to be placed are called liquidity. Imagine that we are in an uptrend. If institutions want to buy, they need sellers. But since we are trending upward, most traders are looking to buy. Suppose that price forms support before reaching the demand zone. This support will be an area where retail traders place buy orders. Beneath that support, their stop losses are sell orders. Smart money can use those stops, grab the sell liquidity, and place large buy positions. Liquidity zones serve as further confirmations to execute high-probability trades when they form above or below a zone. There are many types of liquidity, but we mainly focus on equal highs, equal lows, and stops. Stop losses define liquidity. Where the stops exist, liquidity exists. Order blocks are optimized supply and demand zones. We consider the last recent candle that created inefficiency as an order block, regardless of being bullish or bearish. But there are 3 rules for a valid order block. It must have inefficiency. It must lead to a break of structure or a change of character. It must remain unmitigated. Unmitigated means it has not been tested by price yet. Order blocks are one-time use. Once mitigated, we no longer consider them tradable. In 2 conditions, we use wicks as order blocks. First, when the shadow of the order block candle is larger than the body. Second, when the shadow of the following candle grabs the orders. Next, we have market structure, who's in control, supply or demand. Imagine this is a 1OR structure, and price reaches a demand zone. It would seem logical to look for buying opportunities. But if prices just come from an unmitigated 4-hour supply zone, then supply is in control. We must trade the controlling side of the market. Suppose you are waiting for a demand entry, but price is approaching from an unmitigated supply zone. In that case, supply has control, and demand trades require confirmation. Always check where price came from. There are 2 conditions in which we can use risk entry. First, when price breaks through supply, giving us a bullish higher time frame bias. Second, when price breaks structure but has not yet reached the unmitigated supply zone. Let's use an example. Imagine a 4-hour structure showing a clear downtrend. Supply is in control, even though the short-term trend shows higher highs and lows. As long as price remains below the 4-hour supply zone, we maintain a bearish bias. But if price breaks that zone, demand takes control. From there, as long as price stays above major demand, the bias is bullish. If price breaks demand to the downside, supply takes control again. Now that you understand the foundations of how smart money trades, let's move on to 3 of the best entry strategies. Before we dive in, If you are finding value in this content, please give the video a thumbs up. To build the trading plan, we recommend focusing on one pair in one session. London and New York are the best. Master your chosen pair by backtesting heavily. Go back months, even years, and study every session. The goal is financial and time freedom, not sitting at the charts 8 to 10 hours daily. Remember, every session has plenty of opportunities. The trading plan has 2 steps. Step 1 is analyzing the higher time frames to find market direction, identify who is in control, and locate optimal supply, demand, or order blocks. Step 2 is observing the lower time frames to execute trades based on 3 entry patterns. These are supply and demand flips, change of character, and continuation trades. Let's begin with the supply and demand flip. In this pattern, price creates a new high, tests the last demand zone, but fails to create a higher high. Instead, it breaks through demand with an impulsive move, leaving behind a supply zone. When price retests this level, we place our entry. A live example. Price breaks structure with inefficiency, leaving behind an extreme supply level. After retesting, price fails to make a new high and breaks demand with momentum, leaving behind a perfect order block. We enter short with stops above and targets at the next demand in the higher time frame. This pattern is most effective when price aggressively pushes away with large candles and inefficiency. The next entry is the change of character. This forms after price mitigates a higher time frame zone. It is traded only in the direction of the higher time frame bias. After mitigation, the short-term trend shifts direction with inefficiency, leaving behind a new order block. That is our confirmation to enter. For example, on Euro-Dollar 15-minute chart, the higher time frame was bullish with a perfect 4-hour order block. After price touched the zone, the short-term trend shifted with a strong move, creating a new order block. This showed the downtrend was over and buyers were ready. We enter above the order block with stops below the swing low. Change of character trades are most effective when they break through 2 or more supply and demand zones with strong impulsive candles. The final entry is continuation. This applies only in strong trending markets. Every valid order block with inefficiency becomes a possible entry, but not all will hold. This is why patience and risk management are key. The continuation strategy can give multiple entries, but the key to success is only trading when both higher and lower time frames align in direction. For example, we might see 2 losing trades before the trend continues, and the next order block produces a winning trade. The idea is to win bigger than you lose by managing risk carefully. Now let's put it all together with a multi-time frame example. On the 4-hour chart, we see price break demand to the downside with inefficiency. The candle that caused this move becomes our order block and zone of interest for shorts. So, we have a 4-hour bearish bias. Zooming into the 1 hour, we see a temporary uptrend, but equal highs are forming, which is a liquidity zone. Sellers need buyers, and liquidity is there. Zooming into 15 minutes, price reacts to the 4-hour order block and forms a supply and demand flip. First, price breaks structure with inefficiency, leaving behind an extreme demand zone. After retesting, price fails to make a higher high and breaks through demand with momentum. The candle that caused it is our supply order block. That's our short entry. We place the sell order just below the zone, stop loss above the swing high, and target the next structure level. We adjust stops, new order blocks. We adjust stops and trail profits. That is how smart money trades, combining higher time frame direction, liquidity grabs, valid unmitigated order blocks, and lower time frame confirmations. Thank you for watching this advanced tutorial from Pipeline Trading. If you enjoyed this content, please give the video a like and subscribe for more advanced trading lessons. You're trade smart, stay disciplined, and God bless you.